Check.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. Of course, it's Tuesday. That means that our show's plagued by John Penn this morning, so we will be talking with him a bit after the break. A couple of things we've got to do this morning, though, is we do need to talk about some upcoming economic data. We're going to talk about a little bit about the market sell-off yesterday, why, what happened. Also, talking about two big risks that we're looking at right now. We've got an article published on our website this morning talking about kind of the two risks we're watching right now heading into the end of the year as well as the early part of next year. And so we'll get into that in the next segment. But let's talk a little bit about the economic data coming out. Interestingly, just post the election, consumer confidence and higher stock prices is absolutely rocketed. We saw it. There's multiple measures of consumer confidence. We've got another one out yesterday. But consumer expectations of higher stock prices over the next year has just literally rocketed higher. Everybody's very confident now about their financial situation 12 months from now, which is very interesting because it was about this level in 2020. Just before we kind of shut down the economy, had the pandemic. Following that, during the entire last administration, it stayed at very, very low levels. The outlook for the future was not good. Even though we got past the pandemic, even though we were sending checks to households were very, very downtrodden about the overall kind of financial outlook for themselves. But post this election, with Trump back in office now, that has absolutely skyrocketed back to where it was the last time he was president. So just very kind of interesting to see that survey. A couple other things. Tomorrow we're going to start getting inflation data. So we've got two important inflation data points this week. We've got CPI and PPI. Next week, the 18th, is going to be the Fed meeting. So we will get the Fed rate cut next week. But this data will certainly feed into that decision-making process. They already know the data, but it'll feed into that decision. It's expected, of course, that we're going to come in at about 0.2% on CPI. As I've stated before, it's always 0.2% because that's the average since the turn of the century on a monthly inflation run. So we'll see that. Now, that's going to lead to a slight uptick in the inflation data. So we're going to see inflation strengthen here just a bit on CPI basis because that's the year-over-year comparison working through the system. If we continue to print 0.2, in April we'll be at 1.9% inflation. So we'll be at the Fed's 2% mark in April if we keep printing kind of a 0.2% run. It's just the math. That's all it is. So you're going to see a lot of headlines about, inflation ticked up. Yeah, it did because it's the year-over-year comparison, but actual trends and things like expectations. Again, we go back and look at the consumer expectations report yesterday. Expectations for rent, gas, food, all are expected to fall over the course of the next several months. So again, even inflation expectations are starting to look for lower rates of inflation over the next couple of months. But again, that's going to feed into that report with the Fed, or that Fed meeting next week. Then PPI comes out on Thursday, so we'll see that number. That's the producer side. So that's manufacturers and producers of products, goods, and services. We'll see what their inflation inputs are. So the inputs into them become the output of inflation from those manufacturers to the input of consumers that get that. So the question is how much of that inflation can get passed from the producer to the consumer. Now, this has been one of the big supports for corporate profitability over the course of the last couple of years. And we've seen record high profits of corporations as a percentage of GDP. A lot of that is because of inflation, drove prices higher. We shut down the economy. There was no supply, but you had lots of demand, so that made profit margins really big. But after that, they were able to hold on to that level of profitability because consumers were willing to pay higher prices because they had extra money to spend. Again, we've talked about all this money that's just flowing through the system right now, from checks to moratoriums on rent and all those type of things. That's all coming to an end, but that allowed corporations to hold on to these much higher profitability spreads between the inflation that they were getting and what they could pass on to consumers. We'll start to see here over the next few months as we head into next year, the expectation is the corporations won't be able to pass as much on. They're going to have to start retaining some of that inflation, which is going to lower profit margins and i.e. earnings at the end of the day. So that's going to be a risk going into next year. And we'll talk some more about that upcoming because we're about to hit back into, believe it or not, we're about to wrap up the month here pretty quick, 15 days from today to Christmas. Don't forget, get your orders in. Santa Claus right around the corner. But in just 25 days, we'll be wrapping up the month and starting first quarter earnings season. So we'll be writing some stuff here. Expectations right now for earnings next year are extremely high, very optimistic. We are starting to see those estimates for Q1 already starting to come down as we get closer. So again, we'll update that probably in the newsletter this weekend. But talk more about that as we get closer to the start of earnings season. Okay, let's talk a little bit about what happened in the market yesterday. Here's what you need to know before the bell. So yesterday we talked early on the show before the market opened yesterday that this next 2 weeks, this week and next week, is all about portfolio rebalancing. We saw that yesterday. A bit of the beginning of that. If you owned any of the high beta, high momentum stocks, those got sold off pretty heavily yesterday. The Palantirs, the Nvidias, those type of things that have had really, really big returns this year so far, all kind of really got hit. You saw the same thing really in the top 10, 20% of IWM. You saw a fairly big sell-off yesterday in the small and mid-cap space as well. All those high momentum stocks that are up 50, 60, 70, 80, 90% over the course of this year, all getting sold off yesterday. The reason, not anything fundamental, it's not anything, the market's not crashing, anything like that. All those stocks were grossly overweight. So let's say I own 2% of Palantir in my portfolio. It's now 4% of my portfolio, just round numbers. I've got to sell it back down to 2%. I've got to rebalance that back to my portfolio weight. As we talked about yesterday, and this is part of today's article on the website, if you take a look at the market performance this year, stocks versus bonds, it puts stocks at about 65% of a 60-40 portfolio. So we saw the beginning of that push yesterday, selling off some of those high beta, high momentum names. It was a very big drawdown in momentum yesterday because of that. So again, we saw money kind of rotating in the market. We saw a lot of those high beta names getting sold off. You didn't have a good day if you're a big high beta chaser. Low beta names got a little bit of money flow because they're the most underweight, right? Those stocks have not performed well this year. So those stocks that are owned got brought up to weight in portfolios during that rebalancing process. But this is that process we're talking about. So we're likely to see a little bit more slop. Markets are kind of flattish this morning. We'll see if we can kind of get a little bit of a recovery. But we still have a pretty decent deviation right now between the markets and the moving averages, and we're very close to triggering a sell signal. So if this market kind of goes lower today or the rest of this week kind of just slops around a bit, we're going to trigger a sell signal and likely push this market just a tad lower here heading into Christmas. That's okay. As we talked about what happened yesterday in the markets and what's going on right now is going to set you up for basically, adding some exposure for the year-end rally. I would just be a little bit reticent about doing it this week as we kind of get through these distributions and rebalancing. But we're going to talk some more about this and why kind of the two risks that we're looking at going into next year. When we come back from the break, we'll go through the article that's on the website this morning with you, all the charts and graphs. Don't go away. More coming up on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
You're listening to The Real Investment Show.
And welcome back to the show this morning. John Penn joining me this morning as well. Good morning, John.
Good morning. Good morning.
So we've got a few things to get into this morning. Talking a little bit about tax loss harvesting as part of portfolio kind of rebalancing and those type of things. But I wanted to share something with you first that I posted on Twitter this morning. Just kind of an interesting chart. I wanted to get John Penn's opinion on this as well. There was a graph out this morning by a company called Verone. I'm not sure how to pronounce it, so forgive me. But shows what does financial success look like to different generations, right? So, so for baby boomers, financial success is if you got a $100,000 salary and a net worth of about $1 million, you've succeeded. You've done well, right? You've kind of achieved some level of financial success. Gen X, $212,000 and $5.3 million in the bank.
Okay.
So, and this is total net worth. So this is including assets, 401k, house.
This includes your
that,
real
right?
estate?
Yeah, your
Okay.
real estate, the whole 9 yards. So 5.3 million. Millennials, 181,000. So I thought this was interesting. Their salary requirements actually went down a little bit.
I'm surprised by that.
Yeah. And so, but their goal for net worth is 5.6. So 5.3 for Gen X, 5.6 million for millennials. Gen Z, I thought was the most interesting. 588,000 in salary with a $9.5 million net worth. That's the level of financial success that the way they view it. And I think a lot of this has to do with what they see on, Instagram and TikTok and a lot of this. I saw a girl, she was a fairly large individual, not real well dressed. And she's making a TikTok and she says, I won't date anybody that doesn't make $600,000 a year. And
Wonder how many hits she has.
well, and the goal is that is a very rare salary. Making $600,000 a year is very, very difficult to achieve. It's doable, right? It's absolutely doable. But it's when you take a look at salary spreads across the United States, that's a very, very small percentage of individuals making that much money.
And let alone from a couple standpoint,
Yeah.
or significant others that are together, just from a combined, like a total income standpoint. It's rare to see a combined income household of, $500,000 or more.
Right.
Right.
Well, and then of course the kicker is on that graph is it shows you what the actual average salary and net worth is. It's $64,000 is the average salary.
Yeah,
across
that sounds more like it.
Yeah, this is across all generations, right? Not just a generation. This is across all generations. The average salary is $64,000, and net worth is about $1.1 million.
Yeah.
Which, now mind you, that's not bad. If you're making $64,000 a year and you've got $1 million of net worth, congratulations, you're actually doing fairly well. If you make 30, it was very interesting. I saw a study out recently. They were talking about, the poorest states in America. Mississippi is the poorest state in America. The average salary is about $31,000. They are wealthier than almost every other country in Europe.
You got to think about that, right? That puts a lot into perspective, I think.
Yeah. If you make $30,000 a year, you're in the top 1% of global income earners at $30,000 a year. So at $64,000 a year, it's pretty amazing. Now, and again, we've got all these distorted views about, salary and success, and a lot of this comes off social media and stuff. But I think what this chart really kind of brings out is that my kids are going to be very disappointed.
Yeah, I mean, look, our oldest daughter graduated from college last year.
Yeah.
And she started her first kind of post-college career. And she's back here in Houston, and she's an underwriter. She's a credit analyst for a local bank here in Houston.
Right.
And actually, coming out of school, her starting income is, to me, I think it's great. I mean, compared to what I was making when I was coming out of school, I look at what they're paying her. I'm like, man, that's not too bad. But you also have to look at
cost of living
and rent, and vehicle insurance, all cost of food, all those things too, right? But yeah, you got to put all that into perspective. But if it's on TikTok, it's got to be true, right?
Of course. Social media, it's great. But again, it's just a story. I think you see all these social media posts of kids with Lamborghinis and Range Rovers and stuff like that.
G-wagons.
Half of them aren't even theirs. They're they're just standing in front of somebody else's G-wagon.
Yeah.
But it distorts the view of what kind of reality is, and kind of expectations, and I think that's going to be a real great. And again, this is also why you see a lot of anger about the financial system, because the reality is that most people are going to make somewhere between $50,000 and $100,000 a year. That's about reality. Now there's easy ways to achieve more income, easy ways to do that. But the reality is if you're probably working for a company, being an employee, you're going to make I shouldn't say that, between 60 and 150, say somewhere in there. That's probably going to be more like the reality going forward, because that's just the cost of being an employee, right? But there's certainly ways to achieve much higher incomes that can certainly do it. But again, you don't see the reality on social media, kind of what's really going on in the economy, so that you can understand why there's so much anger about, well, why can't I make, why won't you pay me $500,000 a year to do my job as a receptionist or whatever? It's just money, right?
Yeah, I mean, I'd like to go buy that new Mercedes or high-end vehicle, right? I mean, I remember coming out of school, I was just happy to have wheels. I was just happy to have a ride.
You had more than one wheel?
I did.
That was awesome.
I did.
I was on a unicycle coming out of college.
In high school, I was just lucky to have a car. And I remember when one night, my dad was like, hey, we're going to go to Sears. This was when Sears was still in business. And the next day, he goes, we're going to go to Sears this weekend. We're going to get you some new tires. I was like, sweet. All right. So Saturday morning, we get up and we're walking out, and he stops and he turns around and he looks at me. He goes, you got your checkbook with you? And I was like, oh, I'm buying these tires.
Yeah.
All right. But I look back on that, and it taught me a lot about being financially responsible and having expectations. And, if you do service, if you're a homeowner or vehicle owner, whatever that might be, whatever your income is, I look back on that, and I appreciate it now very much.
No, my son learned that same valuable lesson. I would watch him drive, and he's hitting the brakes hard, getting up to a stop sign or a stoplight, and and turning really fast around corners, those type of things. I'm like, you're going to regret this for two reasons. One, you're going to get in a wreck, right? And that's on you. And the second thing is that you're going to wear out your brakes and tires, and that's on you.
And that's also on you.
Yeah. And so it probably wasn't 2 months after that, his brakes started going out.
Yeah. And
a brake job on his car was not cheap. And I was like, well, let's go get your brakes done. And he thought I was paying for that.
Yeah. Gee, thanks, Dad.
Yeah. Yep. So, but yeah, you know what? He drives really well now. He drives very well now.
Well, it kind of teaches you a level of appreciation for what you have, and so regardless of what your income is, if it's $30,000 a year, $60,000 a year, 120, 150 north of that, you appreciate everything that you're working for, right?
Yeah. Yeah, and this is, look, I get a lot of grief. Like recently I was talking to one of our clients. He's like, I don't agree with you about the way you raise your kids. And I'm like, that's completely okay.
Sure.
Right. How we raise our children that's a personal thing, right? I do things my way, and that's the way I do it. My whole reason for making my kids pay for everything is just to learn responsibility. If they ever get in real trouble outside of going to jail, that's on them. You go to jail, don't call me. Daddy's not bailing you out. That number is dead.
Yeah.
But if you get into trouble, I'm going to help you. That's my job as a parent. But I'm not. But the thing is I'm not going to bail you out, and I'm not going to enable you. Right. The one thing I see a lot is I see the biggest mistake parents make is they keep bailing out their kids over and over. And once you start that process, you become an enabler of bad habits.
Well, so and kids figure it out at a very young age. And I cannot tell you the number of individuals and families that I work with where moms and dads are in their 60s and 70s, and sons and daughters, I mean, these are grown adults, and they keep coming back time and time and time again.
Yeah, that's enabling.
Where mom and dad pays off sons and daughters' credit cards. So I'm just going to pay it off this time. Oh, when's the last time you paid it off? Well, it was about 2 years ago, and now my son or daughter's kind of gotten themselves back into some financial trouble again. Okay, what does that look like? Well, they've run up their credit cards again. And John, I want to help pay them off. It's like, okay, well, there's only so many times you can do this where now you're putting your own retirement in jeopardy. And will your son and daughter be there for you when it's your time of need? So there are that's part of this too. There are some tough conversations that we have to have. And kids, they learn this at an early age. And guess what? When they are grown men and women, the behavior doesn't change if you're not. You got to be careful about that.
Yeah. Absolutely. Absolutely. Well, we really digressed off the topic, so it's all right. When we come back, we'll jump into the article real quick on I'm just going to fly through a couple of charts with you really fast. If you go to the website, realinvestmentadvice.com, it's covering portfolio rebalancing and valuation risk going into the end of the year and beginning of next year. But there's just a couple of important charts I want to show you on that. And then we'll talk a little bit about tax loss harvesting when we come back from the break as well, because it's that time of the year. And we actually had this conversation yesterday after we had our investment committee meeting yesterday morning. And then we had basically the investment team got together and says, well, should we do some tax loss harvesting? And they go, what losses?
There's not much to choose from this year. Yeah.
Actually, we did it earlier this year. So we're actually in really good shape. So, but yeah, we can't forget CVS, John. My bane of my existence. But we'll write it off this year. It's all good. All right. Come back from the break. We'll do all that. Don't go away.
Can't you see that love is everywhere? Step into the confusion. Can't you hear the sound that's in the air? It's rock and roll. 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 It's rock and roll.
The Real Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today. Register today.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Over the weekend, my wife wants to string some lights along the back porch for Christmas. And so I go, hey, you know what? I'll get my son to do this.
The Real Investment Show podcast.
So I said, here, take these strands out there. You and my daughter's boyfriend, y'all go out there and string these lights for him.
Same show, your schedule.
And as soon as they get out there, they unstring the lights. My son steps on 3 of the bulbs, breaks the bulbs. We don't have any replacement bulbs for them. So we have no lights now.
At realinvestmentadvice.com.
We don't get our kids to do things. We do them ourselves because we want them done.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back. All right, so let's talk a little bit about today's article on the website. If you go to realinvestmentadvice.com, you can read the whole article. I just want to jump into a couple of quick charts here real fast because this is going to lead to our conversation about tax loss harvesting, kind of some things to do, and then also being careful of things like the wash sell rule on this as well. But this year, the market has done very, very well. Obviously, we're up about 30%. Well, with dividends, we'll be up about 30% by assuming the market ends kind of where it is right now, we'll be up about 30% by the end of the year. Bonds on using AGG, which is the Barclays Aggregate Bond Index, is just kind of a global benchmark for bonds. That's up about 3% for the year. So again, bring that chart up. So you just see this huge performance gap. So if I'm running a 60-40 allocation right now using these numbers, I've got 65% stocks and about 35% bonds. So that's this risk of rebalancing that we're talking about. And saw a little bit of that yesterday. Don't be surprised if we see a little bit more of that. Doesn't necessarily mean every day is going to be down. Just expect kind of some sloppy, volatile trading, or maybe over the next week or so. That's also just kind of historically within tendencies of what happens in markets over time. But the one chart I really want you to notice is this chart right here, which is the stock bond ratio. This is simply just a S&P 500 divided by TLT. That's all that is. So SPY, you can do this chart yourself. SPY versus TLT. That's the blue line. Normally, the stock bond ratio trades between about 1.5 to 2.5 times. So in other words, stocks, at the peak previously on average would be about 2.5 times, TLT. And during kind of bear markets, it's generally around 1.5. We're at 6.5 times TLT right now. So we just have this massive explosion in equity performance versus bonds, and that's just not normal. You shouldn't have this type of deviation historically. And again, whenever you've had very high levels of the stock bond ratio, that kind of also preceded things like the financial crisis, the end of QE, Brexit, the Fed tapers, COVID pandemic, just kind of all that stuff. Just because you get these imbalances in the market, and that's what you've got going on now, is just an extreme imbalance in the overall market. So, this is kind of one of the things that over the next couple of weeks we could see. Now, I'm not saying, by the way, that you're going to revert that stock bond ratio all the way back to 1.5 to 2.5. I'm not saying that at all. I'm just saying you've gotten portfolios way out of balance, so you're going to have a bit of rebalancing that goes on. The other big thing going into the end of the year and beginning of next year is valuations. And we've been running up stock prices on expectations of elevated earnings growth. We talked about this yesterday. In 2023, everybody expected earnings to grow at about 15%. They turned out to be 9% in 2024. Going to next year, they're expecting 19% earnings growth. So if you take a look at that in this chart, that puts earnings growth well above the long-term upper peak-to-peak trend of earnings going back to 1900. So you've just got very, very high expectations for earnings that are growing faster than the overall economy, and that's not sustainable long-term. You're going to have a correction at some point in that. But just looking at earnings for next year, here's a chart of just, kind of puts this in perspective. Here's a chart of earnings. So the black line is earnings going back to 2014 to present. That's the black line. And you'll notice that within some wiggles, right? We had a couple things like in 2020, you had a big depression in earnings. And then, of course, when you have a recession, you're going to get a big snapback in earnings and of course, we flooded the economy with money. And then over the last couple of years, we've come back to that trend line of earnings. Well, we're now expecting estimates. That's that dotted red line. Now we're expecting estimates for earnings to go well above that long-term trend. That typically doesn't happen. We're probably going to run closer to that trend line. So right now, earnings estimates for next year are at $251 a share. You can put this down on your calendar when we get into next year. Remind me that I said that I think we'll be closer to 220 by the end of next year. So we'll have a little bit of a benchmark here. We'll see how close we can get. But 220 would be that trend line in earnings, and that would also be about a $30 decrease in earnings estimates right now, and that'll happen gradually over time. By the way, it won't happen like overnight, but over the course of the next year, we'll just keep kind of cutting earnings until we get closer to that trend line. But the problem with that is valuations. Because again, we're way overpaying for stocks at the moment. In fact, we've got some of the highest valuation levels really since we go back to the dot-com crisis in terms of where valuations are running. And give me this last chart, Brent. Consumer expectations of higher, this is consumer confidence of higher stock prices. That's at an all-time record. And that red line in valuations is we're pushing up. This is forward earnings. So this is incorporating that $251 a share in forward earnings next year. We're almost at 27 times earnings. We were about 28 times earnings in the dot-com peak. Forward earnings, right? So if we go trailing, we're over 30. So, valuations are very elevated. The point about this is that going into next year, we're all very optimistic. And if something happens and we don't really start to meet these very elevated expectations next year, we could potentially see a valuation reversion as valuations kind of start to catch up with earnings reality. And again, that's not a crash. I'm not saying the markets are going to crash, but we could see a much sloppier year next year where markets maybe not do a whole lot overall, a lot of volatility, and that allows earnings to come down, valuations to come down, and markets to kind of realign themselves with a little bit of kind of the longer term trends. We'll see what happens, but I think those are the two big risks going into next year: is earnings disappointment and this portfolio rebalancing. Going into the year end is your near term risk, and valuations next year I think is the next risk.
Well, I think that's what everybody's really trying to figure out at this point. Excuse me. This year was all about the election. That's behind us. It's been all eyes on the Fed. We expect a 25 basis point decrease next week. And now a lot of the conversations I'm having, Lance, with folks is, well, what do we think about 2025? What's going to happen? Yeah. Right. What's going to be what's the outlook for not just the market but also the economy too? And you talk a little bit about valuations, and something I like to look at is the Shiller PE ratio. Mm-hmm. Look at the Cape 10, and as of late, it's at the second highest reading versus 2000. Right.
But you got to be careful with that, though, right? And this is and I'm just reading chat comments while you're doing this, and people in our chat are like, I think it's going to crash. The problem with the Shiller's Cape ratio, which we use all the time. I'm not poo-pooing it at all, so don't think I'm trashing Shiller's Cape PE. I'm not, because it has a lot of value. All that tells you is what forward returns are going to be over the next decade.
Exactly.
It doesn't tell you anything about what the market's going to do in 12 months.
That's right. It's not a predictor.
Right.
It doesn't mean, just because great point. So because the Shiller PE is elevated, it doesn't mean that we're expecting a big crash next year. Mm-hmm. It's just stock prices are high. That's what it's telling you.
Right.
Prices are elevated.
And in the short term, the only thing, valuations are a terrible market timing indicator. The only thing valuations tell you in the short term is if there's sentiment, or if there's a lot of bullish sentiment or not, right? And right now there's a ton of bullish sentiment, so investors are willing to overpay for stocks that will never make that kind of earnings growth in a lot of cases.
Right.
A couple comments, in the chat is like, I can't imagine, Netflix up 400% this year. You've got Meta up 200 or 300% this year. So, these stocks are growing very rapidly relative to their earnings, and at some point you're going to have some kind of meeting of the reality.
Yeah, because folks are trying to get an idea about what future returns are going to look like, because last year, 2023, the broad market S&P was up 26%. Mm-hmm. This year, with dividends, the market's on track to be up 30%. So folks are kind of like, well, I'm kind of getting used to this. I like it.
I do too. It's been very easy to manage money this year. Trust me, it's been so easy to manage. I like years like this because my life gets really easy. I hate years like 2020. That was a tough year to navigate.
Yeah.
Right?
So
we did okay. We navigated it okay. But those are real. I have a lot of heartburn during those type of years.
Well, you just haven't, knock on wood, you haven't seen a lot of volatility this year in 2024, other than maybe mid-July up through the beginning of August. But even that, in any given year, you talk about this all the time. A market move up or down in of 5 to 10% up or down in any given year, that's kind of normal market behavior. We should expect that. But we really haven't seen much of that this year. And so I think markets tend to get a little accustomed to that, right? So looking forward to 2025, now that, prices are arguably elevated, it's just a matter, and looking at the Shiller PE, great point. It's not that, hey, we're expecting a crash. It's just that, hey, prices are up. So what type of forward returns can we expect? Right.
Well, I'm looking at a video right now. They were making some comments in chat about a particular channel. I'm not going to mention which channel it is, with another market's about to crash. So here's some headlines for you. Stocks poised to plunge 55% or worse. 2025 could see a repeat of 2022's market pain. Stocks, buy and hold investors likely to get wiped out. That's 3 different videos in just the last week or so. That type of stuff is going to get you on the wrong side of the trade. Doesn't mean it can't happen, but those are the type of things we talk about here. Is like you've got to set that stuff aside and focus on what you can control. You can't control those type of things, and a lot of these are focused on valuation indicators like Buffett's indicator, Shiller's KPE ratio. Those do not predict crashes at all. They only predict the rate of return in the future. That's all they do. All right, be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Real quick, in chat, there's a couple of comments about Bob Farrell. And Bob Farrell his passing is sorely missed, but is still regarded as one of the most respected technical traders and investors that we've seen in modern history. And we've written several articles about his 10 rules, and they are, and as you stated in chat, they are absolutely golden rules to follow. If you go to our website, realinvestmentadvice.com, there's a search bar right at the top of the page. If you just type in Farrell, Farrell, you'll see several articles, but one of them is called Bob Farrell's 10 Investment Rules Illustrated. And I went through each one of his rules. Now, it's a little bit dated article. This was written back in 2016. Still as relevant today as it was back then. You can just substitute, updated technicals. But, I go through and I illustrate each one of his points, with charts and graphs about the market's valuations, those type of things. But if you don't understand Bob Farrell's 10 rules, read that article, print it out, lay the 10 rules on your desk, whatever. They will keep you out of trouble managing your money. One of them is very relevant right now, which is Bob Farrell's rule number 9, which is when all experts agree, something else tends to happen. Right now, there is not one bearish prediction on the market next year. Doesn't mean a crash. Okay, nothing means the markets are going to crash. But a 10 to 15 to 20% correction this next year, completely possible. I mean, we could go into next year, run 10% up in the markets in January, February, March as we inaugurate Trump and get all excited. Then you have a 20% drawdown into August, September, October of next year through the summer. And then you have a rally into the end of the year, and you wind up about where we are right now.
With just a bunch of volatility in between.
Exactly.
Mm-hmm.
And you look back over the year and go, well, that year sucked. But that's a very likely outcome for next year.
I'm just going to take next year off. Is that good?
Well, I actually asked Richard about this yesterday. So because I was like, we've made so much money this year in portfolios, we should just sell everything, go to cash, and just come back in 2026. He said, no, we can't do that. But
I agree. Yeah, I agree with Rich.
Yep. Anyway. All right. A couple of things. Tax loss harvesting. We've talked about this before. It's the time to do this now. You've only got it. There's actually a few year-end things, and we're going to be hitting on this a few times between now and year-end because I need y'all to get this stuff done by year-end because tax purposes, etc. RMDs. Do not wait until the day after Christmas to do your RMDs. Do it now. Say, get your financial advisor, your institution, they are swamped with it. This is, I was trying to explain this. A guy emailed me the other day. He's like, hey, want to go lunch? I was like, I do not have time. This is tax season for registered investment advisors. This is when we are the busiest of the year right now, trying to get all this stuff done for year end. Get your RMDs done now. Don't forget to do them before the year end. It's very important. Tax loss harvesting, get that done now. If you've got stocks that just haven't been performing this year, they're down for whatever reason, it doesn't matter, sell them. Just sell them. Just take the loss. You can write $3,000 off your normal income next year.
That's right.
And then offset. You can carry those losses forward on your taxes and offset those against future gains so you don't have to pay capital gains tax.
That's right. And you maybe last year, maybe you had some losses that you realized last year. Maybe there were some capital losses last year that you realized. And maybe you want to take some gains this year.
Yep.
You can offset your gains with your losses last year. And to Lance's point, if you still have some capital losses left over, you kind of have a bank of losses. You can use up to $3,000 of those capital losses to offset your ordinary income.
Right.
And let's say that bank is big. Maybe after you use that $3,000 to offset your ordinary income, you may have some money left over. Well, you can kind of roll that money forward and keep using it until it's exhausted. Right?
Well, I saw a comment in chat that said, maybe I'll rebalance, after the first of the year. No, rebalance now. Because again, you probably have losses from 2022 that are sitting on your books. Take some gains now and your big winners and pull those back a bit, offset those against your previous losses. Take the tax-free gain while you have it. This year, and then next year you can kind of have a clean slate to work with.
Yeah, and so some things that you have to kind of watch out for if you are trying to harvest some losses or realize some losses. And I've been having a lot of questions around this lately. 'Tis the season. It's required minimum distribution season. It's, hey, we're trying to get Roth conversions done before the end of the year. Your Roth conversion, if you're wanting to convert money to a Roth IRA for 2024, that needs to be done by December 31st.
And don't wait until December 30th to do it.
Yeah, right. So custodians are pretty efficient. I mean, they can get this done pretty quickly, but towards the last week of the year, folks start taking off, and this is kind of a little bit more of a skeleton crew. It's just this over the next 2 weeks. This is the time you really want to make sure you get this done. But around the tax loss harvesting side, what you have to watch out for is if you have taxable brokerage accounts with multiple custodians. Let's say you have a taxable brokerage account at Schwab. Let's say you have one at Fidelity. Let's say you have one at Vanguard. If you sell a stock at a loss in your Schwab account, but then you mistakenly, let's say you buy it in your account at Fidelity within 30 days, you just nullified that tax loss that you just took at Schwab, right? These are, sometimes folks think that, well, I'm going to take this loss at Schwab, and I'm going to wait the 30 days or really 31 days before I buy it back. But they decide to buy it back in a different account with a different custodian. The tax loss rules kind of go across custodians. You're not isolated at one firm.
Right. And so this is really important. The wash sell rule is really important. There's a definition basically to the wash sell rule which says you cannot buy back the same or like asset. Right.
Substantially identical.
But it's interesting because it doesn't really apply to ETFs.
Yeah.
Which is interesting because, in other words, I can buy a BlackRock S&P 500. I sell that one at a loss. I can turn around and buy a Vanguard after 30 days. I can buy a Vanguard S&P 500, and that's okay.
Yeah.
It's weird because ETFs they're not considered to be the same instrument. I think eventually they're going to catch on to that. But don't bank on that. What I would do in that case, and again, that also means you can't swap an S&P index for S&P stock options. Those are identically the same thing, right? So don't push your luck with the IRS. It was interesting that I was talking to a neighbor the other day, and he's having an IRS audit, and I'm like, yeah, it sucks. I've been through them before. The IRS is the one agency you just don't want in your life. It's just a hassle, right? It's just for whatever reason. So just don't push your luck. If you sell something at a loss, wait 31 days and then buy it back.
Yeah.
And you're not going to miss that. You're not going to miss that much, right? In whatever investment it is, unless it's NVIDIA that goes up 300%. But or Palantir or whatever. But yeah, just wait the 31 days or buy a different asset entirely. Just sell it and then go buy something else for the time being.
Yeah, and there's a number of folks that we work with too, where where you're working with an advisor. The advisor's helping you with your longer term portfolio strategy, and then maybe, there's a strategy that you're kind of managing on your own off to the side. Mm. If you are selling positions at a loss in your own self-directed account, it's not a bad idea to reach out to your advisor just to say, hey, John Lance, hey, I'm selling XYZ over here. Hey, do me a favor. If you decide to buy this position, don't buy it for me for at least the next 31 days. Yep. Because if we don't know what you're selling on your side at a loss, and let's say the market pulls back a little bit and there's a good entry point on a business that we want to enter, if it just so happens to be the one that you just sold, guess what? We just created a wash sale for you. Right. So you got to if you are managing assets on your own, make sure that always make sure you're communicating with your advisor. Right at the end of the day, but especially around this time of year, if you're taking some losses on your own, just make sure you're on the same page with your advisor too.
And did you mention that this does not apply to Roth?
It does not. Yeah, within
401ks.
Yeah, so within retirement plans, 401k plans, 403bs, traditional IRAs, Roth IRAs, SEP IRA, simples, it's like bubble gum, boiled shrimp, fried shrimp, IRAs. Within IRAs. You can't harvest losses in an IRA. So this is really only applying to taxable accounts.
Tax-deferred, tax-free accounts, this doesn't apply. It's only for taxable accounts.
Taxable accounts, that's right.
And by the way, this brings up a really important thing right now. If you like to speculate in the markets and take a lot of risk on your portfolios, completely okay. Do it in a taxable account. In your Roth IRAs, in your regular IRAs, be super conservative because you can't contribute a lot of money to those accounts. So if you lose a big chunk of money in that account, well, you can't really just replace it with new funds and start growing it again. So your losses potentially, and nobody ever thinks about losses, right? It's like, well, if I buy this there and it goes up a bunch in my Roth IRA, it's all tax-free gains. That's true, but taking a lot of risk in that Roth IRA can really backfire on you. And the second thing is you lose your ability to do your tax write-offs. So do all your speculation in a taxable account. Be more conservative, long-term growth, dividend-type stocks in your things that aren't going to kill you in a market downturn. Do that in your Roth IRAs and in your IRAs. Grow that money cautiously over time. Take your speculation risk over your taxable account where you can manage your tax losses and all that type of thing.
So talking a little bit about tax write-offs, I mean, there are a number of folks, too, that I visit with where they want to place real estate in their IRA.
No, ever.
What are your thoughts around that?
Terrible.
That was a quick answer.
Yeah, no, you lose. The whole reason you buy real estate is for all the write-offs.
You want to be able to write off your expenses.
Exactly. And you can't do that.
That's right.
Tax-deferred account. It's like, duh.
Yep. I get those questions, too. Mm-hmm.
All right. Wrap up the show for the day. Appreciate y'all being here. Be sure and smash that like button on the way out the door. We appreciate it very much. Be back tomorrow with Danny Ratliff, and we'll talk about, of course, tomorrow is CPI. So we'll have that to discuss, on Thursday with Michael Leibowitz. We'll talk about the inflation and Fed. So anyway, have a great day. See you back here tomorrow on the next edition of the Real Investment Show. See ya.